Hey family, and welcome back to Building Wealth Today TV. I'm so glad you're here. We're tackling a question I know many of you have asked. Can you borrow against your life insurance? Life throws us curveballs, and sometimes we need access to extra cash. Could your life insurance policy be the answer? For years, we've been taught that life insurance is about protecting our families in case the unexpected happens. But here's the thing. Some life insurance policies are about so much more than just that safety net. Certain types of policies like whole life, universal life, and indexed universal life allow your money to grow over time. This cash value is where the magic of borrowing comes in. We'll explore the steps involved, the potential benefits, and the risks you need to be aware of. By the end of this video, you'll understand how life insurance loans work, when they make sense, and how to avoid common pitfalls. We'll walk through real-life examples of people who used these loans to their advantage. So, if you're ready to unlock the potential of your life insurance policy, let's dive in. Let's break down what a life insurance loan is and how it works. Certain types of life insurance policies build up cash value over time. This cash value isn't just sitting there idle, it's yours to access. A life insurance loan allows you to tap into this accumulated value without surrendering your policy. It's like borrowing from yourself, using your policy's cash value as collateral. Not all life insurance policies come with borrowing power. This feature is typically found in permanent life insurance policies. The most common ones that allow for borrowing are whole life, universal life, and indexed universal life insurance. Each of these policies has its own set of features and benefits when it comes to borrowing. Term life insurance does not build cash value and therefore doesn't offer loan provisions. Imagine your life insurance policy is like a house you own. The death benefit is like the structure of the house itself. The cash value you build within the policy is like the equity you have in that house. Just as you can take out a home equity loan, you can take out a life insurance loan using your cash value as collateral. When used wisely, a life insurance loan can be a valuable tool for accessing funds. Life insurance loans are not your typical loans. They typically do not require a credit check and often have lower interest rates. The loan is secured by your cash value, so the insurance company takes on less risk. Life insurance loans offer flexible repayment terms, but it's crucial to manage them responsibly. If you don't make regular payments, the interest can accrue and impact your policy. The first step is to reach out to your insurance company. They can guide you through the process and answer any questions. You can usually find their contact information on your policy documents. Give them a call, send an email, or schedule an appointment. Be prepared to provide your policy number and any other relevant information. The next step is to request a policy illustration. This document outlines how taking out a loan will impact your policy. Review the illustration carefully and ask any questions you have. Having a clear understanding is essential for making informed decisions. Once you're comfortable with the potential impact, submit your loan request. Many insurance companies offer online applications for convenience. Ensure all the information you provide is accurate and up to date. Double-check your personal details, policy number, and loan amount before submitting. Congratulations! You've successfully navigated the loan request process. Once approved, the insurance company will disperse the loan amount. Many offer direct deposit, with funds typically appearing in your account within a few business days. Alternatively, you may receive a check to deposit at your bank. While life insurance loans can be valuable, they are most effective when used strategically. Assess your financial situation and goals before borrowing. Explore alternative financing avenues. A well-informed decision is an empowered decision. Now that we've covered the what and the how of life insurance loans, let's delve into the why. You might be wondering, when does it actually make sense to tap into this resource? Well, let me tell you, there are countless scenarios where a life insurance loan can be a lifesaver, literally. Take Sarah, for instance. She's a single mom working hard to provide for her 2 kids. When her car broke down unexpectedly, she was devastated. She needed it to get to work, take her kids to school, and manage everyday life. A new car was out of the question on her tight budget, and she didn't want to go into debt with a high-interest car loan. That's when she remembered her life insurance policy. She'd been paying into it for years, and it had built up a decent cash value. She contacted her insurance company, and within a week, she had the funds she needed to buy a reliable used car. The best part? The interest rate on her life insurance loan was significantly lower than any car loan she could have qualified for. Sarah's story highlights a crucial reason why people turn to life insurance loans: accessibility. Traditional lending institutions like banks often have stringent requirements, and securing a loan can be challenging, especially if you have less than perfect credit or limited credit history. Life insurance loans, on the other hand, offer a more forgiving path. As we discussed earlier, they typically don't involve credit checks because you're essentially borrowing against your own money. This can be a game changer for individuals who might face roadblocks with traditional lending avenues. Moreover, life insurance loans can provide a financial bridge during times of transition or when unexpected expenses arise. Imagine you're facing a medical emergency, need to make a down payment on your dream home, or have to cover a child's education expenses. These are all situations where having access to funds quickly and without the hassle of a lengthy loan application process can make a world of difference. Life insurance loans offer that flexibility and accessibility, empowering you to navigate life's challenges with greater financial peace of mind. Now let's shift gears and talk about entrepreneurship. Starting a business takes guts, determination, and of course, capital. But securing funding, especially in the early stages, can feel like an uphill battle. Banks are often hesitant to lend to startups, and venture capitalists can be highly selective. This is where life insurance loans can step in as a valuable ally. Many entrepreneurs, like Michael, have tapped into their policies to secure the seed money they need to get their ventures off the ground. Michael always dreamed of opening a bakery, but he didn't have the savings to make it happen. He was hesitant to approach banks, fearing rejection due to his limited credit history. That's when he discovered he could access the cash value he'd built up in his life insurance policy. With a loan secured against his policy, Michael was able to purchase equipment, rent a space, and hire his first employee. Today, his bakery is a thriving neighborhood hub, and he's well on his way to paying back his loan. Michael's story exemplifies how life insurance loans can empower individuals to take control of their financial destinies and pursue their entrepreneurial dreams. Consider using the money borrowed from your life insurance policy to support venture capital-style projects and earn a return. Let's take a look at 3 examples where this practice yielded significant returns. James invested in a food truck partnership using a $20,000 loan from his whole life insurance policy. James loaned the funds to a friend's food truck business in exchange for 15% equity. The truck became profitable within 8 months, and Marcus earned $7,200 in distributions the first year and retained long-term equity. He then used part of the profits to repay the loan over 2 years. Priya launched her own digital course business. She borrowed $20,000 from her indexed universal life insurance policy. She paid for course creation, website, and ad campaigns. She made $28,000 in sales in 6 months, and then reinvested $10,000 and paid off the policy loan early. There were no taxes due because the policy stayed active. Jamal seed-funded a real estate deal for $50,000 using his whole life insurance policy. He partnered with 2 other investors to purchase and flip a duplex. The property sold 5 months later for a $42,000 profit. Jamal's cut was $14,000. He paid back the loan with interest, kept $9,000 profit. While life insurance loans can be a game changer for entrepreneurs and venture capitalists, their utility extends far beyond the realm of business. Life is full of surprises, both big and small, and sometimes we need a little financial wiggle room to navigate those twists and turns. Maybe your basement floods, requiring unexpected home repairs. Perhaps a loved one falls ill and you need to cover their medical expenses. Or maybe you simply want to take that dream vacation you've always postponed. In these moments, where flexibility and quick access to funds are paramount, life insurance loans can be a saving grace. They provide a safety net, a way to address life's curveballs without derailing your finances or incurring high-interest debt. Remember, your life insurance policy isn't just a piece of paper. It's a powerful financial tool that can be leveraged to enhance your life and achieve your goals. All right, everyone. Before you rush to tap into this resource, it's absolutely crucial that we address the elephant in the room, the risks involved. Think of it this way. Just like navigating a ship through water, borrowing from your life insurance policy requires careful consideration of the potential hazards. While the calm waters might seem appealing, there are hidden currents and potential storms that could jeopardize your financial journey. Ignoring these risks is like setting sail without a life vest or a weather forecast. You might be fine for a while, but if the unexpected hits, you could find yourself in troubled waters. So let's dive into some of the key risks associated with life insurance loans, so you can approach this financial tool with open eyes and a clear understanding of both its benefits and its potential downsides. The interest factor. A slow and steady drip can erode your wealth. One of the most significant risks to understand is the accrual of interest. When you take out a life insurance loan, you're essentially borrowing money, and just like with any other loan, there's an interest rate attached to it. While the rates on these loans are generally lower than those of credit cards or personal loans, they can still add up over time, slowly chipping away at your cash value if not managed carefully. Now, here's where it gets a little tricky. Unlike traditional loans, where you typically make regular payments to cover both the principal and the interest, life insurance loans offer more flexibility. You may have the option to make interest-only payments or even skip payments altogether. While this flexibility might seem appealing at first, it's essential to understand the long-term implications. When interest is not paid, it's added to the outstanding loan balance. And yes, you guessed it, interest is then charged on that accumulated interest. This is known as compound interest. And while it can work wonders when you're earning it, it can be detrimental when you're on the owing end. Over time, this compounding effect can significantly increase the amount you owe, potentially even exceeding the cash value of your policy. If this happens, your policy could lapse, meaning you'll lose the death benefit protection and any potential future growth of your cash value. So, while the flexibility of life insurance loans can be advantageous, it's crucial to approach interest payments strategically and avoid the trap of deferring them indefinitely. A shrinking safety net. The impact on your death benefit. Another important risk to consider is the potential impact on your death benefit. Remember, the primary purpose of life insurance is to provide financial security for your loved ones in the event of your passing. However, when you take out a loan against your policy, you're essentially reducing the amount of money your beneficiaries will receive. Here's how it works. When you die with an outstanding loan balance, the insurance company will typically deduct that amount, along with any accrued interest, from the death benefit payout. So if your policy has a death benefit of $500,000 and you have an outstanding loan of $100,000, your beneficiaries would receive $400,000 instead. Now, you might be thinking, well, I'll just repay the loan before anything happens. And while that's certainly the ideal scenario, life, as we know, is full of unexpected twists and turns. None of us have a crystal ball. We can't predict the future. So it's crucial to carefully assess whether borrowing against your life insurance policy might compromise the financial security you've put in place for your loved ones. If your primary goal is to maximize the death benefit for your beneficiaries, exploring alternative financing options that don't directly impact your policy might be a wiser choice. The ultimate risk policy lapse and its financial fallout. Now let's talk about the most significant risk associated with life insurance loans: policy lapse. A policy lapse occurs when you fail to make the required premium payments, or when the outstanding loan balance, including accrued interest, exceeds the cash value of your policy. In essence, it means your policy is no longer in force, and you lose all the benefits and protections it provided. Now, you might be thinking, well, that's only a problem if I stop paying my premiums altogether. And while that's partially true, it's not the whole story. Even if you continue making premium payments, your policy could still lapse if the interest on your loan accumulates faster than your cash value grows. Imagine a scenario where your cash value is growing at 3% per year, but the interest on your loan is accruing at 5% per year. In this case, the interest is eating away at your cash value faster than it can replenish, putting your policy at risk of lapsing. A policy lapse can have significant financial consequences. Not only do you lose the death benefit protection for your beneficiaries, but you might also face tax liabilities. Yes, you heard that right. Taxes. When a policy lapses, the IRS could consider any outstanding loan balance as taxable income. So it's not just about losing the insurance coverage, it could also result in an unexpected tax burden. Mitigating the risks, strategies for responsible borrowing. While the risks associated with life insurance loans are real and significant, it's essential to remember that they are not inevitable outcomes. By approaching these loans with a cautious and strategic mindset, you can mitigate these risks and utilize this financial tool responsibly. First and foremost, knowledge is your best defense. Take the time to thoroughly understand the terms of your policy, the interest rates associated with loans, and the potential impact on your death benefit and cash value. Don't hesitate to ask your insurance agent or financial advisor any questions you may have. They are there to guide you. Next, consider your repayment strategy carefully. While the flexibility of life insurance loans can be tempting, it's crucial to have a plan in place to manage interest payments and ideally pay down the principal whenever possible. Even small, consistent payments can make a big difference in preventing interest from snowballing out of control. If you're facing financial difficulties and are struggling to make payments, don't bury your head in the sand. Reach out to your insurer and explore potential options, such as adjusting your premium payments or exploring temporary hardship programs. Remember, your insurance company wants to work with you to keep your policy in force. The tax-favored status of life insurance, a foundation of financial planning. Let's delve into a topic that often causes confusion but is crucial for making informed decisions about your life insurance policy taxes. The good news is that, in general, life insurance enjoys a favorable tax status. This means that, under current tax laws, the death benefit paid out to your beneficiaries upon your passing is typically tax-free. This tax-free status is one of the cornerstones of why life insurance is such a valuable tool for estate planning and ensuring your loved ones are financially protected. They receive the full benefit amount without having to worry about a portion being siphoned off by taxes. Now, when it comes to borrowing against your policy, the tax implications are a bit more nuanced, but in many cases, they remain favorable. The key is to understand the rules and approach borrowing strategically to avoid any unwelcome surprises from the IRS down the road. The policy lapse pitfall, when tax-free turns taxable. While we've established that taking out a loan against your life insurance policy is generally not a taxable event, there's one crucial caveat you need to be aware of: policy lapses. Remember, a policy lapse occurs when you fail to make the required premium payments, or when the outstanding loan balance, including accrued interest, exceeds the cash value of your policy. Now, here's where taxes come into play. When a policy lapses while you have an outstanding loan balance, the IRS views the situation a bit differently. Instead of treating it as a simple loan repayment, they might consider a portion of the unpaid loan balance as taxable income. Why is that? Well, when a policy lapses, you essentially lose the life insurance coverage, and the cash value, which was acting as collateral for the loan, is no longer available. The IRS sees this as a form of distribution or withdrawal from the policy, and certain distributions from life insurance policies can be subject to taxation. It can get a bit complex, but the key takeaway is that a policy lapse can turn a generally tax-free situation into one where you might owe taxes. All right, now that we've thoroughly explored the world of life insurance loans, let's step back and compare them to other common financing options. It's like shopping for a new car. You wouldn't just settle for the first one you see without exploring different models, comparing features, and finding the best fit for your needs and budget, right? Similarly, when it comes to borrowing money, it's essential to weigh your options carefully. Life insurance loans have their unique advantages, as we've discussed, but they're not a one-size-fits-all solution. Other options, such as personal loans, home equity lines of credit, and even credit cards, might be a better fit depending on your specific circumstances and financial goals. So let's put life insurance loans head-to-head with these alternatives, comparing key factors like credit checks, interest rates, collateral requirements, repayment terms, and potential risks. By understanding the strengths and weaknesses of each option, you can confidently choose the borrowing strategy that aligns best with your financial needs and risk tolerance. One of the most significant advantages of life insurance loans is that they typically don't require a credit check. This can be a major plus for individuals who might have less than perfect credit history or limited credit history. Remember, with a life insurance loan, you're essentially borrowing against your own money that's accumulated within the policy. The insurance company already has a vested interest in ensuring the loan is repaid, so they don't need to scrutinize your credit score as rigorously as a bank would for a personal loan or a credit card company would for a new line of credit. This can be a breath of fresh air for those who've experienced the frustration and stress of credit denials or unfavorable loan terms due to past financial hiccups. However, it's important to note that while life insurance loans might not involve a formal credit check, the insurance company might still review your payment history on the policy itself. If you've frequently missed premium payments or have a history of policy lapses, it could potentially impact their decision-making process or the terms they offer on the loan. So, while the absence of a traditional credit check is a significant advantage, it's still essential to maintain responsible financial habits, even within the realm of your life insurance policy. The interest rate equation, unveiling the true cost of borrowing. Now, let's talk about one of the most crucial factors to consider when comparing loan options: interest rates. Interest rates determine the true cost of borrowing money. The higher the rate, the more you'll end up paying back over the life of the loan. Life insurance loans generally offer favorable interest rates, often lower than those of personal loans, credit cards, or even some HELOCs. This is because, again, life insurance loans are secured by the cash value of your policy. The insurance company faces less risk since they can deduct the outstanding balance from the death benefit or cash value if you pass away before repaying the loan. Some policies might have fixed interest rates, while others might have variable rates that fluctuate based on market indexes. It's crucial to carefully review the terms of your policy and compare interest rates from different lenders to ensure you're getting the most favorable terms possible. Beyond the numbers, collateral, repayment flexibility, and risk tolerance. While credit checks and interest rates are essential factors to consider, they don't paint the whole picture. When comparing life insurance loans to other options, you also need to factor in aspects like collateral requirements, repayment flexibility, and your own risk tolerance. One of the unique aspects of life insurance loans is that they don't require any additional collateral beyond the cash value of your policy. With a personal loan, you might need to put up assets like a car or savings account as security. Similarly, HELOCs are secured by your home equity. This means that if you default on a personal loan or HELOC, you could risk losing those assets. With a life insurance loan, the collateral is built into the policy itself, providing a level of security and peace of mind. Another key difference lies in repayment flexibility. Life insurance loans typically offer more lenient repayment terms compared to traditional loans. You might have the option to make interest-only payments, skip payments altogether, or even choose a balloon payment structure where you make a lump sum payment at the end of the loan term. However, it's crucial to remember that this flexibility comes with a caveat. While deferring payments might seem tempting, it can lead to interest accruing and compounding over time, potentially eroding your cash value and even putting your policy at risk of lapsing if not managed carefully. Remember, your financial journey is a marathon, not a sprint. It's about making informed choices, seeking professional guidance when needed, and staying committed to your financial well-being. So keep learning, keep asking questions, and keep building wealth the smart way. If you found value in this video, like, subscribe, comment, and share with others. Thanks for watching Building Wealth Today TV.